Hi, this is Amin, a California-based registered investment advisor. This week's big story, the government shutdown is finally over. While it lasted, it took a real toll on the economy. This wasn't just a political fight, it was a serious setback for American families and businesses. Here's a quick look at what it cost and what comes next now that the government is back to work. The main measure of our economy's health is the GDP, or gross domestic product, the total value of all goods and services we produce. During the shutdown, GDP growth slowed sharply. The Congressional Budget Office estimates the long shutdown cut this quarter's growth by anywhere from $7 to $14 billion in economic activity. It's a small size slice of our $30 trillion economy, but it's still a real avoidable loss. Why did it happen? The ripple effects were straightforward. Hundreds of thousands of federal workers and contractors went unpaid for weeks. Even though federal employees will get back pay, the lost income caused people to cut spending immediately. Fewer restaurant meals, delayed trips, and postponed big purchases. Programs like SNAP, the Food Assistance Program, were disrupted, reducing the spending power of millions of low-income families. Unpaid and exhausted TSA agents and air traffic controllers caused travel delays and cancellations, hurting tourism and travel. Key agencies that approve loans, contracts, and permits shut down or operated on skeleton staff, pausing billions in business deals and investments. Now that the government is open again, much of that activity will rebound, but not all of it. Some losses, like missed park visits or restaurant meals, are gone for good. Economists expect a short-term slingshot effect as back pay and delayed spending hit the economy, but the total damage leaves a small, permanent dent. With agencies back to work, we'll also start seeing normal economic data again, inflation, unemployment reports, and other metrics. This will end weeks of uncertainty. Finally, something remarkable and potentially risky is happening in the tech world right now. The biggest names in technology are borrowing record amounts of money to build the infrastructure powering artificial intelligence. We're not talking millions or even billions of dollars. We're talking about hundreds of billions of dollars. In 2025 alone, tech firms issued $141 billion in AI-related debt, more than all of 2024 combined. Global AI infrastructure spending could hit $3 to $4 trillion by 2030. Major players like Microsoft, Google, Amazon, Meta, and Oracle are leading the charge, with capital expenditures nearing $350 billion this year alone. The twist? They're now using borrowed money instead of relying solely on cash. Oracle's massive $300 billion cloud deal with OpenAI is a prime example. It may need to borrow around $100 billion over the next 4 years to build the necessary data centers. Oracle already has $82 billion in long-term debt, and its debt-to-equity ratio is over 400%. Compare that to Microsoft, which is at 32%. Oracle is not alone. Meta financed a $30 billion AI data center in Louisiana, the largest private debt deal ever. AI-related corporate bond issuance hit $75 billion in just 2 months this fall, nearly matching the total of the previous 5 years combined. This frenzy feels like an arms race, not for weapons, but for computing power. The idea is simple. Whoever owns the most powerful AI infrastructure will lead the future economy. OpenAI's Stargate project alone could reach 7 gigawatts of capacity and cost more than $400 billion in 3 years. To power it, companies are buying mountains of NVIDIA chips and securing electricity for facilities that together consume as much power as millions of homes. But here's the catch. The money is swirling in a loop. OpenAI signs huge deals with Oracle, AMD, and Amazon, funded by investments from NVIDIA and Microsoft. Company A borrows to Company B, which borrows to buy from Company C, which invests back in Company A. It works fine until it doesn't. The shift to heavy borrowing brings pressure to deliver real profits. For example, analysts calculate OpenAI would need to grow its revenue from $12 billion today to over $300 billion by 2030 to justify its commitments. Meanwhile, data center depreciation could hit $40 billion a year, while revenues lag at $15 to $20 billion. That's like spending $40 to earn $15. Not sustainable. Other warning signs: AI hardware becomes outdated fast, lasting only 2 to 4 years. Data center debt has more than doubled this year, and Moody's recently gave Oracle a negative outlook, citing its rising debt and cash flow risks. On the bright side, all this AI building is fueling job growth in construction, chips, and energy, making tech a major driver of U.S. economic growth. But if this debt-fueled spree crashes, the fallout could shake markets. AI stocks have pushed the S&P 500 to record highs, but investors are counting on these companies to make their massive bets pay off. In short, we're at a crossroads. Either these investments usher in a new era of productivity and innovation, or they spark one of the biggest bubbles in corporate history. U.S. companies could issue up to $1.9 trillion in new bonds next year, much of it for AI. That's a lot of borrowed money riding on a future that hasn't arrived yet. For everyday Americans, this matters. These companies drive the stock market, employ millions, and shape how our economy works. If their bets succeed, we could see faster growth and new opportunities. If they don't, the hangover could be painful. The stakes and the debt have never been higher. That's it for this week. Stay tuned for the next edition, and as always, your feedback is welcome. You can find my email in the show notes. Thanks for listening, and happy investing.